Hello, welcome to the show. It's the Man and Market Show and I'm Charles Boji, your host. Now, it appears to be holiday for power consumers in Uganda, at least if it to go by the tariffs that are being charged on power across different consumer categories. Now, what we are getting is that the new entity responsible for distributing power in the country, that is the Uganda Electricity Distribution Company Limited, which has now taken over from Umeme, has been able to bring down these power tariffs. Of course, it is a government decision taken from those that are concerned, beginning with the Electricity Regulatory Agency. It is Man and Markets once again. I'm Charles Boji, your host. Welcome.
I'm honored, in line with the Electricity Act, to announce that the Electricity Regulatory Authority has approved the electricity end user tariffs to be charged by UEDCL for the supply of electricity during the period April to June 2025. In arriving at the end user tariffs, I'm going to announce what the authority considered and the major assumptions. One, demand. We expect the demand to grow at an annual rate of 10.4% in 2025. The second assumption is that Umeme Limited license for distribution and supply of electricity and the concession agreement expires by midnight today. The third assumption is that the quarterly tariff adjustment methodology implemented by the authority since 2014 and the subsequent years, which adjusts the annual base tariff for changes in inflation, exchange rate, international fuel prices, and other costs approved by the Electricity Regulatory Authority, will continue to be implemented in the year 2025. 4. The Uganda shilling has appreciated against the United States dollar of shillings 3,689.10 used in determining the retail tariff for the first quarter of this year to now shillings 3,679.73 as of February 2028, as published by the Bank of Uganda. This represents an appreciation of the shilling of 0.25%. Assumption 5 is that UEDCL tariff performance targets for 2025 following the license for sale and distribution of electricity issued to them will continue to hold. 6. We shall continue to review the implementation of the public amenities customer category. The public amenities customer category includes street lighting, hospitals, and cooking for institutions. 7. We shall continue to review the composition of the medium and large industrial customer categories to provide separate customer categories for electricity consumers involved in manufacturing compared to those who are providing services. The next assumption is that we shall continue the implementation of measures to reduce the electricity end user tariff for manufacturers pegged on predetermined demand growth targets for the year 2025. Next is that we shall continue the implementation of the declining block tariff structure for large industrial manufacturing customers for the tariff year 2025. There will be cessation of the declining block tariff structure for the extra large industrial customer category effective midnight tonight. There will be continued implementation of the domestic cooking tariff of Uganda shillings 412 per unit to encourage domestic consumers to cook using electricity between the 81st and the 150th unit of electricity consumed monthly. Now, following a thorough review of the application along with the public feedback received during the publication period and the public hearing that was held, the authority has approved the following end-user tariffs. 1. Lifeline tariff will be shillings 250 per unit for qualifying domestic customers. These are customers who will consume up to only 100 units. So beyond 100, you don't qualify for lifeline tariffs. 2 is domestic tariff. This is now the cost reflective tariff. It will be 756 shillings and 2 cents per unit for other domestic consumers beyond the first 15 units. Now we have the commercial tariff. This will be 546 shillings and 4 cents per unit. Medium industrial tariff will be 355 shillings and 1 cent per unit. The service will be shillings. The public service will be, the amenities will be for manufacturing. Then for the service under manufacturing will be 412 shillings and 5 cents per unit. The large industrial customer tariffs. Block 1 will be shillings 304 cents per unit. Block 2, which is a declining block tariff, will be shillings 282 and 9 cents per unit. The large consumer tariffs. The services will be 348 shillings and 7 cents. The extra large industrial tariff will be shillings 203 and 6 cents per unit. The public amenities tariff, the hospitals, the cooking and so on, the universities, will be shillings 360 per unit. Now all other charges remain unchanged. The connection charges and all those others will remain unchanged.
In 2014, Uganda exported gold worth $3 billion US dollars. Now, to put this in local currency, that is in the excess of 10 trillion Uganda shillings. Putting this in context, Uganda's total budget is somewhere around 50 trillion Uganda shillings. Now, this is a huge sum. It's a huge consideration if you're looking at where Uganda is, but then also, most importantly, this area portends huge potential to transform this economy. But players say it can actually be better than that if we had our act right in the space of value addition for minerals, all the minerals that Uganda produces in air.
A major lesson that has been picked through Uganda's journey into the oil and gas sector is that it's costly to attract investors into the mining industry without knowing what you exactly possess. In her production sharing agreements with oil and gas sector players, Uganda commits to meet, among others, the cost of exploration once commercial oil production commences. The bigger issue is that the exploration companies have a lot of leeway to determine these, given the fact that the country had not done much exploration on its own earlier. To sector players, this places us at a disadvantage in regards to the broader mining sector.
Mining has a lot of potential when you look at what other countries have been able to achieve with their mining sector. But Uganda still has some of the challenges that we need to overcome to be able to realize the potential of the mining sector. And one of the challenges is establishing the actual resource base that this country has. Because until you establish how much you have in terms of minerals, until you do the exploration and you are able to determine the resource base, then you don't have enough data to sell to the investors. Because the investors would be attracted if they knew that this is the resource base that the country has.
The bigger loss here would be the failure of the country to attract good investors into this crucial sector. To this end, sector actors are calling on government to take charge of exploration as a step towards helping the country get the best out of the mining sector, considering the fact that good investors tend to follow good data.
If it is a given mineral, whether it is gold, you need to know the reserves. How much reserves does the country have for an investor to come and put in money? But we are still depending on the private investors to come and invest in exploration. And this is a very, very, very expensive venture, and most investors are not interested in exploration.
However, beyond attracting the mining sector players internationally, pundits are also calling for the nurturing of SMEs in the sector, referencing achievements that have been made by peers who have taken that route.
As we unlock this potential, as other countries discover that in growing your people, you have a much more bigger base. Instead of mortgaging your people as a government in sovereign guarantees to Chinese, get smaller money and grow with your what? With your people. Tanzania has figured it. We are always on forums debating. Last month, Tanzania, through their Minister of Mines, declared that halfway the financial year, they had made 597 billion Tanzanian shillings. Those who know good mathematics, that's about 2.7 trillion Uganda shillings from mining. That money was, 70% of that money was made from small scale miners.
Uganda has massive mineral depots in almost every corner of the country. The challenge, though, is that its quantity remains unknown for the most part, and the country is yet to build a critical mass of technical know-how and capital among its people to exploit and explore these minerals.